Hello everyone, I am Ashish Kumar and I will be talking about debt versus equity. What is debt? Money raised by the company in the form of borrowed capital is known as debt. It represents that the company owes money towards another person or entity. They are the cheapest source of finance as their cost of capital is lower than the cost of equity and preference shares. Funds raised through debt financing are to be repaid after the expiry of specific term. Debt can be in the form of term loans, debentures, or bonds. Term loans are obtained from financial institutions or banks, while debentures and bonds are issued to the general public. They carry fixed interest which requires timely payments. The interest is tax deductible in nature, so the benefit of tax is also available. Debt can be secured or unsecured. Secured debt requires pledging of an asset as security so that if the money is not paid back within a reasonable time, the lender can forfeit the asset and recover the money. In the case of unsecured debt, there is no obligation to pledge an asset for getting the funds. Now, what is equity? Equity refers to the net worth of the company. It is the source of permanent capital. It is the owner's funds which are divided into some shares. By investing in equity, an investor gets an equal portion of ownership in the company in which he has invested his money. The investment in equity costs higher than investing in debt. Equity comprises of ordinary shares, preference shares, and reserves and surplus. The dividend is to be paid to the equity holders as a return on their investment. Investment in equity shares is the risky one as in the event of winding up of the company, they will be paid at the end after the debt of all the other stakeholders is discharged. There are no committed payments in equity shareholders, that is, the payment of dividend is voluntary. Apart from that, equity shareholders will be paid off only at the time of liquidation, while the preference shares are redeemed after a specific period. Now, debt versus equity. Capital is the basic requirement of every business organization to fulfill the long term and short term financial needs. To raise capital, enterprise either used owned sources or borrowed ones. Owned capital can be in the form of equity, whereas borrowed capital refers to the company's owed funds or say debt. Now, basis of comparison in debt versus equity. Funds owed by the company towards another party is known as debt. Funds raised by the company by issuing shares is known as equity. Debt is basically a loan funds, equity is own funds. Debt reflects obligation, equity reflects ownership. Status of holder in case of debt is lenders. Status of holder in case of equity is proprietors. In terms of risk, debt is has a less risk, and in terms of equity, equity has high risk. There can be term loans, debenture, bonds in case of debt, and shares and stocks in case of equity. The return in case of debt is interest, while the return in case of equity is dividend. The nature of return in debt is fixed and regular, while the nature of return in equity is variable and irregular. Key difference between debt and equity are: debt is the borrowed fund while equity is the owned fund. Debt reflects money owed by the company towards another person or entity. Conversely, equity reflects the capital owned by the company. Debt can be kept for a limited period and should be repaid back after the expiry of that term. On the other hand, equity can be kept for a long period. Debt holders are the creditors, whereas equity holders are the owners of the company. Debt carries low risk as compared to equity. Debt can be in the form of term loans, debentures, and bonds, but equity can be in the form of shares and stock. Return on debt is fixed and regular, but it is just opposite in the case of return on equity. Return on debt is known as interest, which is a charge against profit. In contrast to the return on equity is called as dividend, which is an appropriation of profit. Now, the conclusion is it is essential for all the companies to maintain a balance between debt and equity funds. The ideal debt equity ratio is 2 is to 1, that is, equity should always be twice of the debt. Only then it can be assumed that the company can cover its loss effectively. Thank you.